Welcome back. You're here with us on NDTV Profit. Nifty continues to be lower by 40 odd points as we speak, 8,193 where it is trading right now. European markets have also opened up and they have opened with a bit of weakness as well. So there you have CAC 40 down 1%, FTSE 100 lower by 0.81% as we speak right now. Vaibhav Agarwal, banking analyst at Angel Broking, is now joining us on the show to talk about the banking space in particular. Thank you very much, Vaibhav, for being with us here on NDTV Profit. Good to have you on the show today. I wanted to have your comments on Axis Bank. The stock is down 6.28%, and the news that we've got that the bank sold two of their loans, bad loans rather, to ARCs in the second quarter. Both belong to the power sector, and they were classified as standard asset in the first quarter. How do you read this development, and what does it mean for the stock?
Well, clearly that was the negative surprise that came in, Axis Bank's results. Somewhere the market was contemplating a certain amount of stressed asset addition, by the bank. And, as we now understand that this 1,800 crores is over and above, what they would expect to do, in terms of stressed additions. To an extent, the fact remains that in the earlier quarters, they had created contingent provisions for just such a kind of asset. The P&L impact was therefore, mitigated by the contingent provision. So to that extent, after all, that's what the contingent provisions were for. It's just that, somewhere in terms of the overall stressed addition, guidance that one had in mind, this 1,800 crore came as a negative surprise. The management has maintained their guidance on credit cost for the coming, 2 quarters. And, if they maintain that, then, in terms of the earnings, there is unlikely to be a downgrade. It's just that contingent provision now has come down from 1,250 to 400 crores. So the ability to absorb a further negative surprise is reduced to that extent.
And then where does the valuation of this particular stock really go from here? And, this liking of private sector banks over public sector banks, how do you see that changing going forward? I mean, at least for public sector banks, we know that there are bad loans. But for private sector banks, if we get these kind of negative surprises, won't that put, investors in a cautious sort of a stance wherein they would be really cautious before picking up a stock? What do you have to say about it?
Well, some amount of caution is even built into the distinction between the, within private sector banks, those who have more corporate exposure versus those which are more into retail. The ones which are more into retail, like HDFC or IndusInd Bank, are trading at, 3.5 times kind of multiples. I mean, Axis Bank, Yes Bank, these guys are trading below 2 times price to book right now. So to a large extent, valuations are capturing the fact that they are having those corporate exposures. The point remains that in absolute terms, the stressed addition, even after taking this 1,800 crore kind of, sale to ARC, are much lower than PSU banks, which actually is, because relatively they are having lesser NPAs, their P&L impact, to that extent is, far more absorbable than the PSU banks. And that is what still remains a distinction. So if one looks at the earnings outlook and earnings quality on a relative basis, these private banks still remain much better than PSU banks in terms of the quantum of stress that is there in the books.
Right, but Vaibhav, then what would you say about the predictability of earnings for private sector banks? You have a standard asset which you sold to an ARC, taking a 65% markdown. You may provide for contingencies at the start of the year for stressed assets, but then how predictable are these stressed assets anyway? If you're going to sell a standard asset, you don't even put it in the NPA category before providing for it and then selling it off. Just standard asset being sold off. Can you then really predict what the asset quality for leading banks like ICICI Bank is going to be? They have large exposure to corporate groups. We've seen downgrades coming into large groups like Jaiprakash Associates. Is the private sector banking world operating in a separate world altogether? How is it that their asset quality is so different from PSU banks?
Well, all said and done, the point is well taken that the exposures to these stress sectors like infra and, metals, etc. have actually gotten a little bit worse. Especially metals has become a little worse in the last few quarters. That pain would be experienced to an extent by private sector banks as well. It's just that, which is where one needs to look at what could be the ultimate loss and the credit cost that comes to the P&L, and which is where private banks have managed, their exposures better. Even if you look at some of the exposures, let's say of Yes Bank, on the face of it, it looks like a very high power exposure. But if you drill down, you do find that there are distinctions, like, the exposure to renewables is higher, or to higher rated corporates is higher. So one cannot really paint it with one single brush, just looking at the broader exposures. And there is no denying that compared to PSU banks, these stress additions have been lower. It's not that I'm saying that the stress addition is going to come down for private banks. The sectors are in stress, so there will be stress for these guys. But it's built into the projections, it's built into the earnings estimates, and one cannot take away from the fact that the contingency provision has been built over last several quarters. So at least for this specific instance, it would be hard to say that after all the contingent provisions were built up. So would not still go ahead and say altogether that there could be a big increase going forward in terms of P&L impact. I think we would still more or less go with the credit cost guidance that has been given so far.
All right. Thank you so much, Vaibhav, for speaking with us at NDTV Profit. Vaibhav believes that the way private sector banks are managing their bad assets, especially when it comes to the impact on the P&L, it's all been factored into the valuations. This is what Vaibhav Agarwal of Angel Broking had to say. We'll slip into a break. We'll come back with more. Stay with us.